Tilray Brands, ticker TLRY, is currently indicating $1.29 in pre-market trading, reflecting a dip of about 1.5% from its previous closing price of $1.31. This quiet downward drift we're seeing before the opening bell is almost more telling than any sharp, volatile swing. It represents the fatigue of a market that has been promised a catalyst for years. The common belief, the narrative that has held this stock up, is that Tilray is a coiled spring, the dominant global player simply waiting for the gates to the United States to open. The expectation is that you buy at these depressed levels and wait for federal legalization, which will inevitably send the stock soaring. The reality, however, is what this $1.29 price tag truly reflects. This is no longer just a cannabis play. It's a complex, heavily indebted consumer packaged goods company, part craft beer, part spirits, and part struggling Canadian cannabis producer, all wrapped up in a European pharmaceutical distribution business. The market isn't just waiting for legalization anymore. It's nervously watching the balance sheet, questioning if the company's diversification was a stroke of genius or a desperate act of survival. For a long time, the story was easy to follow. Tilray, especially after its significant merger with Aphria, was positioned as the one to beat. It had the scale in Canada, the early foothold in Germany's medical market, and a savvy CEO, Irwin Simon, who understood the CPG world. The strategy was to consolidate, build brands, and use the stable cash flow positive beverage businesses like Sweetwater Brewing, Montauk Brewing, and Breckenridge Distillery to fund the cannabis operations until the real prize, the United States, became available. This was the expectation, but the reality of execution has been far more difficult. The Canadian recreational market became a brutal, low-margin war of attrition, with hundreds of competitors and provincial pricing pressures crushing profitability. The acquisitions, including the recent move to acquire the remaining stake in Hexo, added scale, but also added complexity and, critically, more debt. This is why the stock chart looks the way it does. It's not the explosive growth chart of a new industry. It's the sideways grinding chart of a company trying to service its debt and find a profitable identity while waiting for a political event it cannot control. When we look at the recent trading activity, it's a story of headline chasing. The stock saw a significant spike in interest following the news that the U.S. Department of Health and Human Services, HHS, recommended rescheduling cannabis from Schedule 1 to Schedule 3. The market, in its initial euphoria, bought the rumor, sending the stock up. But then the price faded, just as it has so many times before. Why? Because the market participants did their homework. They realized that Schedule 3, while positive, is not the magic bullet for Tilray. It does not mean recreational legalization. It does not open up interstate commerce. It does not allow Canadian companies, like Tilray, to suddenly start selling their products in U.S. dispensaries. The primary benefit of Schedule 3 would be the removal of the 280E tax provision, a massive financial relief for U.S.-based MSOs who are currently taxed on their gross profit. For Tilray, the benefit is indirect, filtering through its investments in U.S. companies. The realization set in that this was just one more small step on a very long road, and the stock settled back into its skeptical range. The last earnings report was a perfect illustration of this internal conflict. You likely saw management championing the beverage alcohol segment, which is now a significant part of the revenue and, importantly, generates positive cash flow. They would have highlighted the growth in the German medical market, a key pillar of their international strategy. But buried in the numbers would have been the continued softness in the Canadian cannabis segment, where margins remain thin and competition is relentless. Tilray is in a race against time. Can the beverage and international medical segments grow fast enough to offset the Canadian struggles and, most importantly, service the company's substantial debt load? The market's answer, at $1.29, seems to be maybe, but we're not willing to bet on it. Now we must address the other significant force weighing on this stock, an element that is crucial to understanding the day-to-day price action: the short sellers. Tilray has been and remains one of the most heavily shorted stocks in the entire market, not just in the cannabis sector. This isn't a small group of day traders. This is a deep, structural, institutional position. The short thesis against Tilray is not complicated. The bears point to the company's significant debt, much of it in convertible notes that hang over the stock. They point to the persistent net losses and the negative operating cash flow from the cannabis business. They argue that the Canadian market is fundamentally broken and that Tilray's market share, while large, is in an unprofitable pond. They see the diversification into beer and spirits as de-worsification, a distraction that burns capital and pulls focus, arguing that Tilray is simply a roll-up of mediocre assets, propped up by a legalization dream. The data backs up this pressure. The short interest as a percentage of the free float is consistently high, often sitting in the 15 to 20% range. This means for every 5 shares available to trade, 1 is held by someone betting it will go down. Even more telling is the cost to borrow. This is the fee that short sellers must pay to the brokerage firms to borrow the shares they need to sell short. For a stable blue-chip stock, this fee is negligible, perhaps 0.25%. For Tilray, the borrow rate is frequently elevated, sometimes spiking into the double digits. This indicates a high demand for shares to short and a limited supply, a sign of a very crowded negative bet. For investors, it is vital to know how to track and interpret this. You can find official short interest data published twice a month by FINRA. This gives you a snapshot of the total shares sold short. But for a more real-time view, you need to look at data from prime brokers or services like Ortex, which estimate daily short interest and, crucially, the live cost to borrow. When you see a sudden, sharp spike in the borrow rate, it can mean one of two things. Shorts are piling in aggressively, or the supply of shares to borrow is drying up. The latter can sometimes be a precursor to a short squeeze, as shorts get squeezed out of their positions. You should also monitor fails to deliver data from the SEC. A high level of FTDs can indicate settlement failures, sometimes associated with aggressive short-selling tactics. However, I must be clear, trying to trade based on a potential short squeeze is exceptionally risky. These moves are violent, unpredictable, and often end as quickly as they begin. A high short interest is a sign of fundamental disagreement. It's far more productive to understand why the shorts are there than it is to gamble on when they might be forced to leave. What's your own view on this? What's your take on the rising short interest? Smart money or manipulation? Drop a comment below with your perspective. This intense short pressure feeds directly into the retail sentiment we see on forums like Reddit and X. The Tilray community is deeply polarized. On one side, you have the long-term holders, many of whom have held since the Afria merger or before, who are convinced of the long-term thesis. They see the short position as pure manipulation, a coordinated effort by hedge funds to keep the price down. They point to Tilray's unrivaled international footprint, its German distribution network, and a savvy CPG brand portfolio as an economic moat that the bears are ignoring. On the other side, you have frustrated investors and bears who echo the short thesis, pointing to the declining stock price, the persistent losses, and the frustration of management continuing to promise a turnaround that feels perpetually just over the horizon. The discussion is less about fundamentals and more about a battle of wills. Looking forward, the path for Tilray breaks down into 2 very distinct scenarios, a perfect case of expectation versus reality. The bull case, the expectation is that the catalysts finally align. The German government proceeds with its Pillar 1 and Pillar 2 reforms, opening up a massive recreational and medical market where Tilray is already perfectly positioned as a medical supplier and distributor. In the U.S., rescheduling to Schedule 3 happens by early next year, and the Safer Banking Act finally passes, which, while not allowing Tilray to sell in the U.S., drastically improves the health of the entire sector, boosts the value of its U.S. investments, and makes institutional capital more comfortable entering the space. In this world, the beverage business continues to grow, and the company successfully refinances its debt. The combination of improved fundamentals and a sector-wide tailwind would be devastating to the short sellers, potentially triggering a massive squeeze as they rush to cover their positions. The stock would re-rate not as a struggling cannabis firm, but as the global CPG leader it aims to be. Then there is the bear case, the reality the shorts are betting on. In this scenario, U.S. legalization stalls. Politics get in the way, and rescheduling gets delayed or challenged in court. The Safer Banking Act fails to pass the House. The German rollout is slower and more bureaucratic than expected, generating minimal revenue in the near term. Meanwhile, the Canadian market continues to deteriorate, and the beverage business, while stable, cannot grow fast enough to offset the cash burn from the cannabis division and the high interest payments on the company's debt. With debt maturities approaching in the coming years, Tilray finds itself in a difficult position. It is forced to raise capital to service its debt, but at a $29 share price, this means massive dilution for existing shareholders, creating a downward spiral as the new shares flood the market. In this reality, the shorts are proven correct, and the stock struggles to find a bottom. This is the central tension that defines Tilray Brands today. It's a company built on a powerful forward-looking narrative that is now colliding with a difficult, capital-intensive reality. This stock is no longer a simple bet on a changing law. It is a complex play on debt management, CPG brand building, and international regulatory reform. It's fascinating to see where the community stands on this. Comment below how many shares of Tilray you currently hold and what you believe the biggest hurdle for the company right now is. Ultimately, that $29 pre-market price is the fulcrum. The expectation was that Tilray would be a dominant force in a new global industry. The reality is that it is in a fight for its financial life, needing its diversified bets to pay off before its core business runs out of time or its debt load becomes too much to handle. The market is watching, and for now, it remains deeply skeptical.